Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, and Mike Khouw, CNBC Contributor and YieldMax Strategist at YieldMax ETFs. We're here to discuss market volatility and sector rotation. We're also going to meet with Chris Krueger, President of Standard of Care, on mismatches with retirement planning. Lots to unpack here. It's great to have the three of you with us. Let's discuss volatility, rotation, and financials. We're certainly seeing compressed volatility, VIX relatively near lows, and this recent rotation into banks amid Fed cut rate expectations. Brian, let's kick this off with you. Volatility, it stayed stubbornly low. What do you make of that environment right now?
Yeah, we saw the VIX and volatility really kind of pop. It traded up to 26, and now we're sitting back down towards sort of mean average levels for the VIX. It's kind of interesting because you're seeing a lot of volatility in those growth kind of names. It kind of led the charge to the downside, Bitcoin that is to the downside. And then it seems like a lot of these other growth names, we've gotten some earnings reports recently that has sort of raised the level of volatility in the growth. But when you look at VIX, here on this chart, it's really come down pretty hard. And I think Mike and I are used to it as options traders. When we see sort of correlations start to come down, meaning like certain areas of the market doing very well, other parts not doing so well, the S&P or the Nasdaq as a whole starts to get wishy-washy and sidetracked sideways as things kind of shake out and you see this rotation occur. So this is probably why you're seeing the VIX at such a low level, despite some areas of the market having some levels of volatility in it.
Right. And Mike, meanwhile, though, we're seeing capital rotate into financials. What do you think's driving the move there?
Well, I think a little bit of that is certainly going to be some of the rate expectation things. I think a lot of folks, when they think about, because I often will hear folks comment about, to improve housing affordability, we'd like to see rates come down, and then they start talking about Fed rate cuts, as if a rate cut at the short end necessarily is going to drive mortgage rates, which are largely propelled by the 10-year, on the long end. And actually what we've seen in the most recent cuts is actually that the yield curve has steepened. And one of the things we know about a steeper yield curve is that what do banks do? They borrow short, lend long. Steeper yield curves are typically better for financials, and unsurprisingly, we've seen them do reasonably well on the back of all of this. So, and also, I would just add to Brian's point, one of the reasons that on a day like today, you saw that the Nasdaq at one point was down more than 200 basis points and the S&P was certainly outperforming the Nasdaq is because of that rotation that he's talking about that we've seen. It was the really high beta, sort of high risk stocks that came off hard off of the beginning of October. And that sort of move out of the really high beta stocks, I'm talking now about the Hims and Hers, the Palantirs, things like that, in addition to the crypto trade, because those aren't necessarily crypto trades themselves, that has now sort of extended into, bigger names that aren't necessarily part of that, like Hood, that's a name we own, Broadcom, obviously the results weren't all that well received today. And I think that seeing it broaden out, though, and seeing that the volatility in the S&P isn't that great, that's a net positive and sort of gives me some comfort going into the new year.
Mm-hmm. Well, Brian and Mike, let's debate this for a moment here. Brian, is this shift into banks a tactical trade? Is it a timing of the rotation? Or do you think it's something that's more sustainable for the long term?
Yeah, I mean, this shift has been pretty dramatic. If you look at the charts just in the last couple of days, the XLF, which represents financials versus, something like the Nasdaq, really outperforming the last few days. And I think the trigger, to Mike's point, is this yield curve shift, right? The 2-year, 10-year, when we've seen the Fed now cut rates here in December, probably going to get another cut in 26. And if the back end of the curve kind of hangs in there and steepens out, that's probably going to be very good for financials. I think that's what people are expecting here. And that's why you're seeing sort of the run in financials. We've kind of made a little bit of shift ourselves to sort of add just a little touch of financials into our sort of portfolio of stocks. We had been a little bit maybe underweight that, more kind of techie. And I think we're feeling like that shift is real. And that probably kind of continues here.
Yeah. Well, Mike, here's a question though. You have Fed policy as a tailwind versus earnings strength and true fundamentals, right? So is the investment thesis only because rates are coming down? Shouldn't there be more fundamentals behind that?
Well, I think there are more fundamentals. I mean, financials, they're not expensive relative to the market. They're actually cheap relative to the market. Now, I would add a caveat That is generally true. You look at a name like JP Morgan, and this is not a name that you typically see trading 24, 25 times forward earnings. This is the kind of name that's typically, in better times, probably trading 15, 16 times. But, if you're an investor and you're sort of looking at the backdrop for, the rate picture and how that's going to impact, in this case, the money center banks, you have to say, okay, well, I'm actually comforted buying it at these multiples because I think they're going to have the wind at their backs. So, you're getting it at a cheap return to the market. Some of these other stocks, maybe not terribly cheap. And then there's another question, which is, can the rate of growth in the highest flying sections of the market continue? If everybody expects NVIDIA to be the most profitable company next year, but are they expecting it to then turn around and deliver 50, 60% EPS, adjusted EPS growth in full year 2027? I think sort of people are starting to moderate their exposure there because they're moderating their expectations.
Yeah. And of course, it's the end of the year. Can't believe we're saying that already. So let's talk about 401k and asset allocation, something that's perhaps only looked at once a year or at the end of the year. And for that, we turn to Chris Krueger, president of Standard of Care, who specializes within the retirement space. Chris, it's great to have you with us. Welcome to Trade Talks. There's been a lot of talk about mismatches in retirement planning. What's the disconnect that you're seeing?
Yeah, hey Jill, that's a great question. Our users in software see two big disconnects often under looking under the hood of a 401k plan. First, usually investors' risk tolerance doesn't match their asset allocation. Our users will meet participants in retirement plans that potentially say they're conservative but have 95% exposure to equities, or maybe they want more growth and they're sitting in a cash lake fund. They're not doing it intentionally. It's usually just a set and forget approach, or they may have multiple different old 401ks or IRAs or other investments. When combined in view, we find that they're not commonly working together towards that person's risk tolerance. The other thing is, as life and careers changes happen, you shouldn't be what you were at 25 when you're 45. Job changes, income growth. These checkpoints prompt updates, and most people only look at their 401k once a year. In fact, they never ask, does this fit where I should be today?
Yeah, and that's a good point that you make, because we're always taught set it and forget it, especially when you're younger. It'll pay off over time. So, Chris, are people looking at the S&P 500 and just seeing it go up over a 30-year time horizon? Are they just perhaps too complacent about owning a target dated fund?
Yes, there's definitely a comfort factor. Target date funds are easy. In many cases, they're appropriate, but a couple of important challenges often get overlooked. Target dates have become the default fund in most 401k plans. And because they're the default, most people assume that it means they're automatically on the right strategy for retirement. And sometimes that can kind of create a false sense of security. But like any investment, a target date fund needs to be aligned with your risk tolerance, your goals, even your contribution rate if you're saving what you're saving into the plan. And the glide path can't do it all the work for you. Then there's another layer of complexity. Target dates have a 2 or 3 retirement plan glide path. That means how much equity exposure you have towards retirement. Most participants have no idea how these work and how to utilize them to retire successfully. It's important that fiduciaries of retirement plans also understand how their default fund works and to educate plan participants on that.
Yeah, and Chris, there's been big demand this year with retail investors and advisors to get involved in the alternative space. Could you own liquid alternatives in a 401k plan? Is it even worth it to do that?
Short answer is yeah, but there's a bigger challenge that most fiduciaries aren't using these or making them available. Not because they don't necessarily want to, but they don't fully understand how to fit those into their plan investment menus. There's also an education component. Once you add an alternative strategy to a plan investment menu, you now take on the responsibility of helping participants understand, what these are, how they should be used inside of asset allocation. From an investment standpoint, alternatives can be a terrific diversifier. In fact, over the past 15 years, the rise of liquid alternatives have given everyday investors access to these strategies, which historically were only institutional. But used appropriately, they can help reduce volatility, smooth out your ride, and make a more resilient portfolio. So alternatives have a potential role in retirement plans, but something fiduciaries and their advisors should help them figure out.
All right, Chris, we appreciate the insight. Thanks so much for joining us. Brian, speaking of alternatives, what do alternatives look like for a retirement portfolio that needs more than just passive exposure?
Yeah, I mean, Chris brings up a good point. I mean, liquid alternatives own a place in any sort of investment management risk portfolio. I think, the old 60-40 traditional stocks and bonds or index passive funds, you just set it and forget it, like you guys talked about. I think there belongs someplace of liquid alternatives. How you do that? Well, in some 401k plans, you can have them self-directed. And from there, you can kind of educate yourself and add certain, long short strategies, macro trend strategies, CTA programs that are offered actually in fund format, or even, something we do, we're long equities, we're long volatility, so some sort of hedged equity product. Those are the kind of things I would look to sort of add as a small sleeve, call it 10 or 20% in a 401k plan. But, if it's not self-directed, I highly suggest, just like Chris said, reach out to your investment advisor, get educated, whoever is heading up the fiduciary responsibility of that 401k plan, to educate what funds can we add to that sleeve, so that it's just not all about set it and forget it and just hope the S&P has 30 years of progress. Because look, I mean, you've seen what happened in Japan. They had years of nothingness, right? We had 10-year horizons before in the past where we've had these volatility events, and then the stock market does nothing. You don't really want to be caught up in that. And to get educated about different avenues is very important.
All right. Great advice as always. Mike, I want to wrap this up and go back to tech for a moment here and the market's reaction. Quick read on it. Oracle reported, Broadcom just reported. What are you seeing in the numbers? What are investors questioning here?
Yeah, and it's interesting because we had exposure to all of these names. We were actually short Oracle going into earnings. We were long Broadcom. Both actually have sold off. We can see that. The Oracle situation, I view that very, very differently. And one of the things, it's something that Warren Buffett often said, and it's certainly something that I hold dear, which is that when I'm evaluating a company's performance, I kind of feel like the balance sheet is, the window of truth on a business's affairs. And in the case of Oracle, we understand the investments that they're trying to make, but it's adding a heck of a lot of debt. I mean, they got about $100 billion worth of debt right now. And if that turns out to be a little bit too much exposure and investment to this space, they are more exposed than most. And we do see a little of the bloom coming off the AI rose here a little bit. Now, in Broadcom's case, I remain bullish. We continue to hold the stock. We haven't sold it. I do wish we'd had tighter hedges going into the print, to be honest. But, I think that, look, their partnership with Alphabet on the TPU side, I think is strong. And I do think that people who have exposure to NVIDIA, and look, anybody who's involved in the S&P has exposure to NVIDIA, they should actually be looking to broaden that trade out a little bit. We've actually cut our position in NVIDIA completely.
All right. Appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.